Welcome back to the channel. Today we're diving into the world of homeownership again, and this time we will be exploring crucial factor mortgage rates. These rates significantly impact your monthly payments and overall affordability, so understanding what influences them is crucial. I will take the liberty to nerd out a bit on this topic, so buckle up as we uncover a little bit of the mystery behind mortgage rate fluctuations. I'm Bogdan Todorov, your bearded loan guy, and hopefully I can become your bearded loan guide to homeownership, and hopefully that's why you're here. Let's begin with the Federal Reserve, often referred to as the Fed. The central bank plays a big role in the US economy, and their decisions significantly impact mortgage rates. One of their primary tools is the federal fund rate, which is the interest rate banks charge each other for overnight loans. When the Fed raises the federal fund rate, it generally leads to higher interest rates across the board, indirectly affecting mortgage rates. But the Fed doesn't operate in a vacuum. Their decisions are heavily influenced by the state of the economy, and two key factors they closely monitor are inflation and the jobs report. So let's talk a bit about inflation. Imagine inflation as the rising cost of goods and services. When inflation is high, the Fed might raise rates to cool down the economy and prevent prices from spiraling out of control. Conversely, if inflation is low, the Fed might lower rates to stimulate the economy and encourage borrowing and spending. Keep in mind, several inflation measurements exist, each with its own strengths and weaknesses, and the Fed primarily focus on two of them: Consumer Price Index, CPI, and their favorite, Personal Consumption Expenditures Price Index, PCE. Both track price changes of a basket of goods and services with slight differences. Another big influence to the Fed decisions is the jobs report. This report, released monthly by the Bureau of Labor Statistics, sheds light on the employment situation. A strong jobs report indicates a healthy economy, and the Fed might raise rates to prevent overheating. Conversely, a weak jobs report might prompt the Fed to lower rates to boost employment. The Fed has a difficult job. They consistently analyze these economic indicators and attempt to achieve a delicate balance. They aim to keep inflation under control while promoting healthy economic growth and full employment. Based on their analysis, they adjust the federal funds rate, indirectly influencing mortgage rates. While the Fed plays a major role, other factors can influence mortgage rates, and I'll just go over a few of them in no particular order. Number one, bond market yields. Mortgage rates are often influenced by the yields of Treasury bonds, which are issued by the US government. When bond yields rise, mortgage rates tend to follow suit. This happens because investors often view Treasury bonds as a safe investment, and when they become more attractive, investors may be less willing to lend money to the housing market, pushing mortgage rates up. Number two, investor sentiment. The overall confidence of investors in the housing market can also impact mortgage rates. When investors are optimistic about the housing market, they may be more willing to invest in the mortgage-backed securities, which can lead to increased competition among lenders and potentially lowering mortgage rates. Conversely, pessimism among investors can lead to decreased competition and higher mortgage rates. Number three, loan type and credit worthiness. The specific type of mortgage you choose, whether conventional, FHA, VA, USDA, or non-qualifying mortgages, and your credit score also play a role in determining your individual interest rate. The best thing to do is to talk to a mortgage loan officer in your area that you trust to get the best options for your situation. Number four, geographic location. Mortgage rates can also vary slightly depending on your geographic location. This is because housing market conditions and competition among lenders can differ across regions, and the key word here is slightly. Number five, down payment. The size of your down payment can also impact your mortgage rates. Generally, a large down payment will result in a lower interest rate as it reduces the amount you need to borrow and makes you a less risky borrower in the eyes of the lender. Now, to give you an idea of our current environment, and please reference the date this was posted, the US economy is experiencing a moderate growth rate, with inflation hovering around 3.1% from the peak of 9.1 in June of 2022. The Fed has held federal funds rates steady since late July 2023, which has contributed to some stability in mortgage rates. The tight labor market, however, has stalled the disinflationary trend. However, it is important to remember that the economic landscape is constantly evolving, and future Fed decisions could impact mortgage rates in the coming months for the better or for the worse. Let's hope these decisions are for the better. By understanding the factors influencing mortgage rates, you can become a more informed borrower and potentially make better decisions regarding your homeownership journey. Remember, staying updated with economic news and consulting with a financial professional can be invaluable tools as you navigate the world of mortgages. For more information about financing your home, click the link in the video description. I also included my contact information there. And if you made it this far and found this useful, hit the like button, share with others who would find this valuable, and subscribe for more mortgage and homebuyer content. Your bearded loan guy, out.